Hello, welcome to our discussion today about insurance basics. My name is Danny Wilson and I'm a Learning and Development Advisor for Pinnacle Financial Partners. In this particular session, we will be sharing and discussing general financial best practices in relation to insurance products. But of course, we are not providing legal, accounting, or specific insurance advice, and therefore, before making any major financial decisions, you should talk with a professional to get advice that's tailored to your unique situation. We'll start by talking about different types of insurance that most everyone needs. These would include health, life, disability, homeowners, renters, and auto insurance. We'll start by looking at health insurance, and it's important to understand some basic terms when talking about this particular type of coverage. Coinsurance, for example, is where the insurance company pays for a certain percentage of medical costs and you pay the rest. An 80-20 coinsurance split is fairly common, and if this is the case, it means that the insurance company would pay 80% and you would pay 20% after any applicable deductible is met. A deductible is the amount you pay for healthcare services before your health insurance begins to pay. Copayments, also known as copays, are fixed amounts that you pay for certain services such as doctor office visits and exams. Most insurance plans that have a coinsurance component also have a stop-loss provision that kicks in after you pay a specified amount of coinsurance. After the stop-loss amount is reached, your insurance company begins paying 100% of healthcare costs for the remainder of the year. This may also be referred to as maximum out-of-pocket cost. Health insurance plans are usually either a HMO, Health Maintenance Organization, or a PPO, Preferred Provider Organization. A HMO plan requires you to select a primary care physician who is then responsible for managing and coordinating all of your health care. If a specialist is needed, your primary care physician would refer you to them. A PPO plan, on the other hand, offers a network of healthcare providers that you can choose from for your medical care whenever you choose. These providers have agreed to provide care to the plan members at a certain rate. In-network means that the physician or the facility is part of the organization you are covered under. Out-of-network means they are not part of the organization you're covered under. And out-of-network services will cost you a lot more unless an exception is made by your insurance company, such as for an emergency you might have while traveling. Thanks to the Affordable Care Act in 2014, insurance companies are no longer allowed to exclude pre-existing conditions from coverage, nor can they charge you higher rates because of it. If you have a health care plan at work, you likely have access to a flexible spending account, or FSA, which is a special account you can put money into that you will use to pay for certain out-of-pocket health care costs. You don't pay taxes on this money, and so you'll save an amount equal to the taxes you would have paid on the money you set aside. Employers make contributions to your FSA in some cases, but they are not required to, so you'll want to check your plan. Generally, you must use the money in an FSA within the plan year or you lose it. So again, it's very important to read your plan carefully. And if that's the case with your plan, don't put any more money in your FSA than you know you'll spend within a year on things like copayments, coinsurance, prescriptions, and other allowed health care costs. A high-deductible health plan is a health insurance plan with lower premiums and higher deductibles than a traditional health insurance plan. Being covered by a high-deductible health plan is also a requirement in order for you to be eligible for a health savings account. A health savings account, also known as an HSA, is a type of savings account that lets you set aside money on a pre-tax basis to pay for qualified medical expenses. Money may then be withdrawn tax and penalty free as long as it is used to pay for qualified medical expenses. At age 65, however, money can be withdrawn for any reason without penalty, but you would still pay taxes if it's not used for qualified medical expenses. Any unused money rolls over from year to year, so you would never lose it like you might if it was unused in an FSA account. Let's look at life insurance next. It's very important to have the right types and amounts of life insurance, And whole, universal, and variable life policies are all permanent life policies, meaning they stay in force until you die, cancel, or just stop paying premiums. They each consist of an insurance component and a cash value savings investment component. Premiums are typically higher than term insurance, and there are costs and administrative fees which are associated with running the investment side. Whole life premiums and death benefits never change, but there is some flexibility with both in universal and variable policies. Whole and universal cash value is basically invested in a savings type account, whereas variable cash value is typically invested in a mutual fund type account that comes with higher upside potential but also greater downside risk. Term life insurance is perhaps the easiest to understand and usually costs less money. It is a pure insurance with no cash value component with a fixed premium and coverage amount for a specific period of time. Many financial experts recommend keeping your insurance and investments separate, thus getting the proper amount of term insurance for the appropriate number of years and investing money separately wherever you wish. If anyone relies upon you to provide income or services that would otherwise have to be paid for, then you need life insurance. A general guideline is to have life insurance coverage in an amount that equals 8 to 10 times your annual income or 8 to 10 times the cost of services you provide on an annual basis. This would allow the beneficiary to put the proceeds in a risk-appropriate investment that would grow or earn interest at a rate that would somewhat offset the money that's being withdrawn. An often overlooked type of insurance that is nevertheless very important is disability insurance, and there's two major types. Short-term disability insurance replaces a percent of your base salary and typically will pay anywhere from a few months up to 1 year. There's a brief waiting period after the injury occurs before benefits start. Long-term disability insurance also replaces a percent of your base salary, but it will pay a specified number of years or until retirement age, and it has a longer waiting period before its benefits start to kick in. If you are a homeowner, then you are probably familiar with homeowners insurance. A typical homeowners insurance policy covers home and contents against fire, weather damage, vandalism, and things of that nature. Earthquake coverage is optional, and it does not cover flood. However, a separate flood insurance policy can be purchased if it's needed. Most county tax cards and appraisals reflect a value that includes the land your home sits on, but you only need coverage in an amount that will cover the total replacement cost of the actual house. If something happens, you do want to be able to replace the item in question, obviously the home, but also the contents. But with cash value coverage, you would only get what it was worth in its used state. For example, hopefully it will never happen, but if your house was broken into and your big screen TV was stolen, you'd want the $1,500 that it takes to go buy another one, not the $250 it might list for as a 5-year-old used TV in the classifieds. So you want to be sure that you get replacement cost value on your policy. Floaters are important and worth considering too if you have any high-dollar jewelry, art, guns, electronics, or collectibles, because your regular homeowner's policy will have limits to the amount it pays for those types of items. A floater, or also known as a rider or endorsement, would cover that property that would otherwise be excluded. If you're a renter, you may be wondering why you would need renter's insurance since you don't own the building. But renter's insurance will cover your personal possessions and belongings. It also provides liability coverage if a guest of yours is hurt or injured while they're at the place you're renting. And it covers hotel stay if needed due to fire or flood on the premises. If you drive a car, most states require you to have at least bodily injury and property damage liability auto insurance. Bodily injury liability covers personal injury to others caused by an accident where you are at fault. It is shown as coverage per person and per incident. A suggested best practice is to consider coverage in the amount of 2 times your net worth or a minimum of $100,000 per person and $300,000 per accident. Property damage liability covers damage to property owned by others, like a car or a home, something like that. And that damage, if it's caused by you because of an accident where you're at fault, well, that's where this coverage would kick in. A common recommendation is to have a minimum coverage of at least $100,000 per incident. Comprehensive and collision auto insurance is often referred to as full coverage. Comprehensive covers against theft, fire, and various types of natural disasters. Collision covers accident damage to your car if you cause the accident. Many experts recommend that you consider dropping these if your car's value is less than $2,000, simply because the cost of the premiums might not justify the limited amount of money you would get if you filed a claim. Uninsured motorist coverage is a part of a car insurance policy that helps pay for your medical bills or car repairs if you're hit by a driver who doesn't have car insurance. Typically, when you're in an accident and the other driver is at fault, his or her auto liability coverage would help pay for your medical bills or repairs to your car. But if the at-fault driver doesn't have car insurance, you may have to pay out of your own pocket for these expenses. So that's where uninsured motorist coverage can help. Underinsured motorist coverage only provides one type of coverage, bodily injury. This helps pay for your medical bills if you are hit by an underinsured driver, meaning someone who has insurance but not enough to cover all of the expenses. Currently, 21 states and the District of Columbia have laws that make some combination of uninsured or underinsured motorist coverage mandatory. According to the Insurance Information Institute, 1 in 8 drivers on U.S. roads is uninsured, so it may be a good idea to consider uninsured motorist coverage even if it's optional where you live. So those are some types of insurance that pretty much everybody needs. Now let's take a look at some others that you need to consider as well. The first is dental insurance, which is a form of health insurance designed to pay a portion of the costs associated with dental care. Typically, this covers annual cleanings and x-rays at 100%, plus it will pay a percentage or a dollar amount of other dental-related services. Then there's vision insurance, which is also a form of health insurance designed to pay or reduce your cost for routine eye exams, prescription eyeglasses, and contact lenses. If you own a boat, a motorcycle, or an aircraft, then you need to consider insurance for those items as well. Similar to auto insurance, the coverages they provide would insure you against damage to that item if you had a full-type comprehensive and collision coverage, or it would also pay any liability expenses for the liability portion of your insurance should you cause an accident that results in injury to someone else, or if it causes property damage to something someone else owns. Long-term care insurance is a type of insurance that covers the cost of nursing homes, assisted living facilities, and home health care and other long-term care services that are not usually covered by traditional health care insurance or Medicare. An umbrella insurance policy is a liability insurance that's in excess of the liability limits specified in your other policies. So in other words, if you are sued and the liability limits are reached on another policy, such as your auto or homeowners policy, the umbrella liability coverage will kick in to pay the rest of what's owed up to the policy limit. Typically, these policies are sold in $1 million increments. And finally, let's take a look at some types of insurance you may not need. For example, rental car insurance. While you do need to be covered when you drive a rental car, check your regular auto policy. Often it covers you when you rent a car, and if that's the case, getting additional rental car insurance might be considered duplicate coverage. Extended warranties are something that the seller keeps a big chunk of when they sell it to you, as far as the money you give them. Most are never used, and if repairs are needed, they are often more than what's covered. So carefully consider extended warranties before you make a purchase for one of those. And then there's accidental death, burial, and dread disease insurance. But instead of buying policies to cover specific types of death or disease or burial, it is usually much simpler and more cost-effective to just ensure that you have an adequate amount of regular life insurance and health insurance, as discussed earlier, which will cover all of these things as well as everything else that may occur. And pet insurance, while we love Fido, it's probably not necessary. Okay, some of you are probably thinking right about now, wow, Danny, this is a lot of different types of insurance to consider. But whether you're considering getting new insurance or you just want to re-examine the insurance policies you currently have in place, we're here to help. And we also want to do everything we can to help you save as much money as possible and get the best deal that you can. The first thing we would suggest is that you compare rates and shop around. No, you don't have to do this every week or every month, but once every couple of years probably would be a good idea. You can also save a ton of money on your insurance premiums by simply raising your deductibles. You want to be sure to have enough money set aside in savings so that when you do need to file a claim, you have the money to pay for the deductible. But get a couple of quotes with different deductible amounts, and again, you may be shocked at what a difference it can make. You also want to ask for premium discounts. Most insurance companies have a handful of similar discounts, and they vary a little bit from one company to the next, but there's usually quite a few that you might be eligible for. You just have to be sure to ask. And then also, drop any unnecessary coverages. There may be things, small line items in your current policies that simply are unnecessary, and if that's the case, you want to cut those out to save even more. If you have questions and would like to talk further about anything that we have discussed today, please reach out to your financial advisor or stop by one of our local offices. We'll connect you with one of our insurance specialists to make sure that you have the right types and amounts of insurance in place to meet all of your needs.